Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a Strategy of the Day update here for September 14th, 2021. I want to begin the day by taking a look at the US dollar index because as we start to move out of now our harvest season, or really into harvest season, which you could make a good case that based off the WASD numbers, based off of all the other analyst reports, the satellite data, everything else, we have some good indication of how yields across the country and how production's coming out. It's not an exact number, but we're down to really arguing over, a few bushels per acre from a national average perspective. And for all intents and purposes, the real big factor for the rest of the year is going to be the demand side of the equation. So one of the biggest factors we've got going in front of us is movements in the U.S. dollar that could turn off all, our trading partners and increase purchasing power for some of those partners. Take China, for example. They have been known in the past to wait out for more favorable currency conditions before doing purchasing. And all through last year's major purchasing spree, we saw a decline in the U.S. dollar through that period, which resulted in really a very big buying opportunity for any export trading partner. Okay, remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is my own opinion and not a direct trade recommendation. But if you are interested in hearing more of those trade recommendations or working with me as a client, of course, my information is available there in the comment section below, as well as at the end of this video. Feel free to sign up for our Strategy of the Week update as well. It's a mailing list I have to get the link to that weekly webinar I hold every Thursday at 2 p.m. Central, or sign up in the links below to receive the free Zaner Daily newsletter. So the dollar index, I want to begin there, and then we'll take a look at the rest of our row crops here. And actually a quick look at cattle and hogs today. Probably hogs are down in interesting levels, but cattle had a bit of a reversal today, which off of some capitulating news with that JBS plant, fires being put out, not maybe being all the news-worthy event that we've had. We're obviously in a decline in cattle, but we'll take a look at that here in a minute and what that could mean. So the dollar index has headed up and found resistance in that 94 area. The entire 50% retracement from our entire decline would be right around 94 to 95. That is also the old supportive area in the kind of range bound or the arduous trend higher for the dollar we saw all the way through the peak there at the start of the COVID pandemic. We have corrected against that trend in 3 waves now, which could certainly be complete, and the dollar seems to be rolling over here today. We have come back up to find the 55-day moving average at around 92.60 and that 18-day moving average around 92.63 as resistance at this time after breaking below them. But the levels that we found as support for the dollar here down into the 91.80 area, held about a week ago. And we got a little bit of a bounce above trendline resistance. We've tested that area kind of as support. I'm going to go ahead and remove that off the chart because a formation here I want to point out is a bit of a head and shoulders pattern forming on this chart. You've got a neckline down here around the 91.80, 92 figure, and now you've started to get a left shoulder forming, or you have a left shoulder that's formed, up around 93.10. And now the right shoulder starting to form as the market is coming up. You'd expect to see the market, potentially find a high right around that area if it's going to roll over, which it looks like, we might have found here in the near term. Head, of course, forming up here. So not to say that this is a, throw everything you've got at it to sell the dollar here, but if we do start to roll over and see a decline, maybe that could spark here some more purchasing power for those export partners and help the export market in the near term. Now, another move higher here up into the 94 to 95 area would probably cap, in my opinion, the extent of the dollar strength we've seen in the market. And that's certainly because of some of the FOMC and rate rising that we're seeing in the market. Not from the FOMC themselves. We've had more dovish statements there, which of course can be negative for the US dollar. Hawkish statements. Regardless, the point being is we've got a Fed that is willing to continue to print money and keep interest rates low, even though, and we're seeing the counter effects of that happening, in markets like the 30 and 10 year, where we saw some decent rallies and spikes in those futures, which correlates to a drop in interest rates, and of course dollar weakness. But we'll see how that continues to play out into the future. So let's take a look now. I guess we'll start with the soybeans today, the weakest of the bunch. Corn and wheat seem to be a little bit more in lockstep in their short covering rally. I think a big factor there plays into that corn and wheat spread, which is at about $1.80 wide and historically very wide for the difference in those markets. So on the daily time frame here for November soybeans, we've broken below the trendline support that this market found, drawn from the 1240 lows of June through the lows here in August. That area we've been flirting with for the last week here, been unable to close above it, with the exception of that one day earlier this month on September 3rd. But otherwise, we've only spent a few brief movements above. The 18-day moving average proving as resistance here today, again at $12.97. And of course, that key $13 figure seems to be capping the market at this time. The 100-day and the 55-day, we've had a death cross that occurred back on August 24th. And we found those markets, those areas as resistance every time up as well. But, today, obviously, being unable to get above the 1300 level, we haven't even been able to get back to 1335 to test the 55-day or to 1353 to test the 100-day moving average. Trendline resistance against the highs here on this chart continued to hold here through the last month or so of price action, and formed our high here at 1381 for the month of August. September has now made lower lows and lower highs, trending a little bit lower. 200-day moving average down at 1263, traded on Friday in that whipsaw price action in that outside day. But failure to get follow through here is a big concern here for the soybean chart, and a reason why I still got to talk about potential downside down to test those lows of June, and even below down to $12, which again, highs and lows back at the start of this year is our congestion zone that we broke out of, flagged above it, coming back down to test this area of right around $12 as support, is a really big long-term bullish kind of development. But I know it stinks to see the market unable to really formulate and get that rally going. So let's take a look at the 4-hour chart now. Equal legs down if you measure from 1480 down to 1240. We've looked at these levels, extended from 1420 or from 1380, bring up two equal legs down around 1383 and 1330, or 1183 and 1138 respectively. Look for those levels to the downside if we continue lower. The full 50% retracement at this time, that's drawn from the 1422 high down to the lows of this month, would be capped around the 1340 area. I'm going to take it off the chart just so there's not as much on the chart at this time, and we'll get back to that level if we start to see a push above $13 and come back to it and talk about it. But right now, I'm really concentrating and focusing more on the short-term price action and the little bit of a range we've had between $12.70 and $13. This 30-cent range that we've been fighting in for the month of September so far. Again, September is lower lows and lower highs. The lows from the month of August are continuing to hold a support down around 1277. It's also a 50% retracement from the lows at 1262 up to that high at $13 from last Friday. That whole range we've been holding this 50% area, 50 to 61.8 line in the pullback that we had on Monday, and even held it here today. So, the market is potentially trying to break above this trend line drawn from the 1380 highs through this 1340 congestion zone. We failed to break above it there earlier this month, a week ago. We came back up there on the whipsaw news price action, failed to break above. We had only a couple hours here of trade above it before eventually falling back down here below that trend line here at 1282. So very reminiscent of this price action around 1380 and the failure to break above that trend line and close back below. If we see a little bit of selling here below 1280, certainly below 1275, the lows at 1262 definitely are still at risk in this market of seeing a bit of a turnover and price action continuing lower. Full 50% short from the 1340 area down to the lows here pre-WASD report. You can even take it down to the lows of the WASD report at this point. You can see how that's been a inflection zone that traded before here back on the 7th a week ago. It's held again here at $13. It's a nice psychological level. There's a lot of confluence there going on fib-wise as to why being unable to break above $13 is bearishly significant to this chart at this time. If we do get above $13, the next area of resistance will be that 50% from the 1380s down to the lows here at the chart of the 1260s from our WASD report. Again, that larger sloping trend line comes in at that area around 1320. Also have a 50% level at 1320. So, above that, that's where I start to get a lot more bullish. Start talking about $15, $16 beans being back on the table and potentially getting up to that open gap at 1440. That I do think we'll eventually get there. It's just I believe that one more flush out to the downside, that capitulating low this time of year would be pretty significant. And let's not forget, this time last year, we go back to September of last year, we found our lows here for the month on September like 25th through the 29th. So, not as extreme price action. We obviously have a lot more volatility on this chart, but a seasonal trend to the downside here for the second part of September to before low. That really is then the low that takes us through the following year in that demand-driven market is what we're going to be continuing to look for here for soybeans. So I do think we're closer to a bottom than a top, certainly time-wise, but soybeans could have a capitulating sell-off. We break below some key technical figures here, certainly get below that 200-day moving average. You're going to see some fund selling probably way into the market, and that could drive you down 60 cents to even $1 very quickly. But it would be an opportunity, in my opinion, to be a buyer at that time anyway. All right, so with that being said, kind of in the short term, again here for the soybeans, bullish above, bearish below the $13 mark for the short term, which we might find that 13.20 if you get a spike up, but we'll probably change our tone a little bit because corn and wheat will probably be heading a little higher and be driving some other price action there. But again, we start to slip below this 1280 area, below the lows from yesterday at 1276, and this 1260 low. It has been a bit of a grind lower, but at some point, I imagine a little bit of a hair on fire sell-off to ensue, and we'll see if that happens. All right, let's move on to December corn, because we've been a bit of a broken record here for these markets. December corn actually making a very decent recovery here. We're on to our third day. Haven't broke above that WASD high there at the 523 area, but we did make some progress higher today in a higher high and higher low. The capitulating low there with a slight dip below $5 down to 497 lows did take us below the low from May here at 501. So that did clean up the chart in my opinion. It took out all the price action from this range that we've been in. It made it into a complete structure to the downside, but we do have some trendline resistance that we're going to be running up into, and that we are below. If you draw trend lines from through last October through the chart, again that was a break below the 530 area before. There's another little trend line here that we are finding lows to lows. We are still fighting to stay below here at 520 or maybe break above depending on your perspective. But drawn from the 1393 or the 94 highs from last month's WASD through the highs at the end of the month of August, that resistance line comes in right around this 19-day moving average, right around 530 at this time. So we're still below some of those key shorter time frame moving averages for December corn, but we did get a solid test of the 200-day moving average there at 506 now. So again, kind of like soybeans, we slipped below that level. Might be a little bit of capitulation, a reason for the market to head lower. I don't see us really getting below the 450 to 460 area. That was a range here in the market, or that congestion zone from earlier this year. And of course, you got the 477 open gap that I'd love to see December corn close and really clean up the chart. So December corn here on the 4-hour time frame. Again, you kind of do some equal legs measurements. You got a 490 and a 473 downside 100% line. You've also got a upward sloping trend line that comes around 480. You've got the open gap there from back in April at the 477 area. And of course, the full 50% from contract lows to contract highs at 497.5, which was the low to the tick on WASD day. So Getting a technical reaction from that 50% level can't be denied on this chart. It's just a question of, do we get that follow through? That downward sloping trend line here on the 4-hour chart comes in a little bit closer to 525 area. So 530, 525 is kind of that next inflection or resistance zone at this time. That area on the chart also aligns with these prior lows we had for the month of August that eventually got broken, but it was our congestive supportive area that we had held for since late July through August that we broke below. Now we're kind of coming back up to test that area. So I think while we're below 530 is my line in the sand in December corn, we certainly have the ability for the market to roll back over, continue that downtrend, flush out below $5 one more time, find that capitulating low into 477, anywhere down there in that landing zone before making a harvest low. Now we break above 530. We've got a trend line at 550. You want to see us get above 570 as well as I think the more prominent one at this time. But you are going to probably see some resistance as we approach back towards the high end of the range, for December corn. There is a slight open gap, up around 534 that we don't talk about enough, but we have to make a little more progress higher, I think, for me to feel more comfortable with the market getting there, because this has been a big old range over the last several months that we just can't ignore. However, we take off from here and a trend higher, we could be talking about $7 corn. The contract 50% Fibonacci, from contract lows to contract highs, that has a negative 23% target of 704 and an extended target of $8. So the market already has the technical setup on that bigger time frame to get us up to that level. It's now, now we need to start showing reversals happening on the smaller time frame. The daily chart, you've got a 3-day pattern that's starting to form. It hasn't gotten the follow through beyond WASD highs, which still has me a little concerned. There could be some downside, but otherwise it's looking pretty good for right now for a reversal starting off. So for me, corn, I'm bearish above, bearish below at this time, 535 in December. We'll see if that level holds resistance here and keeps us in the downtrend that we've been in, or if we start to reverse higher. On the 15-minute chart, I am watching this trend line against the lows here. Lows from yesterday through lows of today. Not really lows of the afternoon. Lows from Friday through those lows. If we do roll over and we start to break below 518 to 515, could signal a retest to some of these levels and certainly keep us back inside the range we've been in. So watch out for that in the near term for corn. Otherwise, I think the path of least resistance is probably up at this time to get a test of 525 to 530 before the market rolls over, if it's going to roll over. We continue through those levels and continue higher. We could be heading higher in corn. And like I previously mentioned, that wheat to corn ratio right now at $1.80 wide is a little wide. So I wouldn't be surprised to see corn head higher while wheat heads a little lower in the near term. Speaking of wheat, in the Chicago contract, our daily chart is up here. Seems like a bit of a pullback inside of a range or some kind of, stair-stepping higher price action. A test of the 200-day moving average I don't think would hurt this chart down around 670, but that would require, these trend line resistances that I have drawn up that come in right here around $7 to hold. We have now fallen back below the 55-day and 100-day moving average. That comes in around the $7 mark for the 100-day. It's 705 for the 55-day moving average. And that 18-day moving average is dropping pretty quickly here at 718. It'll probably be down to 710 here within the next 24 hours. So I've got resistance on this chart, $7 to 705 for this market at this time. Probably won't see it really get above 710 in my opinion. And again, that's old support here on this chart from end of August, early September, broken down. Cluster of fibs, trendline resistance. Seems like this downward channel that we've been in would find resistance around $7 to 710 before rolling over and take us down towards 670 to 640 to test either trendline support on this chart or certainly the 680 area. Now, when we take a step or take a look at this 4-hour chart, though, we had a head and shoulders pattern that we were talking about with that neckline at 720 that broke. little bit of a left shoulder here at 745, right shoulder here at 745, head up at 786. We broke below that neckline, tested it as resistance up into 730, and then the market, continued lower. It fell right back down to the proposed target area of around 765. It could continue lower to find this 620 area too. But a bounce now from this area kind of creates another neckline. So there's nothing keeping wheat from getting up to test another shoulder pattern here. This would be a 725 shoulder. It'd be a nice little mirrored image here. And the right shoulder could get us up to that area. Yeah, there's certainly a trend line there. We'd have to get above the 710 trend line. And that would also be a test of a full 50% retracement from the 786 high down to the 677 low. That comes in around the 530 area. So definitely still, and I talked about this in our Strategy of the Week update as well as our last Strategy of the Day update. There's definitely a confluence of resistance there, 720 to 730. To look out for if we get above this 705 area, which is kind of our, again, broken support now as resistance, as well as a continuation full 50% short for the month. I want to highlight this fib. There we go. Drawn from 732 high down to the 676 low. That's a 50% level that comes in around 704. So a little higher here if we find resistance into this area and it rolls over. You can kind of understand maybe why and why we might have downside targets towards the 677 area. And of course, below there would take us down, I think, to 640 at this time. But, wheat ultimately caught itself in a trend lower, might be in a much larger trend higher still, given the balance sheet and the national carryout for wheat. But when you look at wheat on a global scale, there isn't as much of a shortage as we have domestically. And one of my concerns with wheat at $7, particularly in the Chicago contract, I believe we might be, there might be some demand destruction going on here for our export market with wheat prices where they are. And considering that corn is at such a discount to wheat, interchangeably so, from a feed perspective at least, corn is the cheaper option right now, isn't it? And at a $1.80 spread, it something's off there somewhat. So we'll see if we'll see if that spread starts to tighten up. That would very much mean wheat prices a little lower, corn prices a little higher, or at least wheat falling relative to corn prices here in the near term. All right, as promised here, I do want to take a look at live cattle. We'll take a look at the October contract, which came down to test the 200-day moving average. I'll also look at December real quick for where its moving averages are, but a test down to 123 here and a quick move below that 200-day moving average might find a bottom here for the cattle market. Down out in the December chart here is a much firmer test of the 200-day at 126.90, or that moved down to 127. But this nice sweeping reversal after yesterday's almost doji close and a gap lower that resulted in almost flat close, hopping into today's price action where we had a gap and go situation to the upside. So October live cattle, because it is our front month contract, broke above the trend line resistance against the highs. Pretty good close for the day, closing positive. We're going to want to see follow through here. And yeah, I'd say to the minimum, you're probably going to get a test back up to the 127 to 128 area, an area that was a little bit of congestion on this chart on the way up, and a little bit of that sideways price action we saw, in this very choppy trend higher. But we fell down in this market to trade the 120 figure, hold above the lows that we had held all through the start of this year, and ultimately still try to keep this year positive, even though it's pretty big drop off of its highs, isn't it? Came down to test old broken resistance, an old supportive trend line now. Okay, cool. But more importantly, I think we failed to really break and stay below this trend line support that if you take a much larger step back on the daily time frame, you can see here drawn between beneath the lows here. We broke below these trend lines, but have now started to try to come back above, at least this most aggressive one. This more channel line, which I'll highlight right now, that is highlighted blue. It's going back to yellow here. That would be broken support being tested as resistance on a move back up to 127 for October live cattle. So I think that while we're certainly above today's low, while we keep this open gap on the chart here at 122, the market's probably going to head up to 127 for a test. And if we could continue on through, there's nothing that says we couldn't continue that trend higher for cattle, as I do think that demand is there. The slaughter pace has been pretty quick, and we're still trading at such a premium to some of those back months or those futures going out into next year. And last but not least here today, we take a quick look at the hog market. October hogs trading at a $16 discount here to the cash markets now, in a pretty big move lower here today. Take us down into a contract 50% area, down into that 80.32. A retest of our prior lows here from June. We tested below, we ran the stops in that area. Equal legs down though, if we measure it on this chart, could take you as low as 76, so I wouldn't be surprised to see us head a little bit lower in a big three-wave correction here. But at some point, if we do start to show a short-term sign of a reversal, which we do not have from today's close, closing negative in a downtrend here is still lower lows and lower highs in this leg lower. But if we do see lean hogs potentially start to show some reversal from this leg lower from 90, there might be some value there, particularly because we've seen lean hogs trade at such a deep discount to cash at this time. We got exports weighing on the hog market, though, and a pork cutout value that hasn't been very strong lately. But as soon as we start to see those cash figures and that more of a fundamental trade start to reverse, the technicals are at least setting up for into an area that could formulate a bottom. Then if we see a technical reversal as well, there's a great reason for a buy signal when fundamentals and technicals start to align in those situations. But it's still a downtrend until it's not. And we did break below that 2-month low here, 3 months worth of lows. Actually, in fact, we closed below the low here from last June. But the July and August lows that we were holding above at that 83 figure, we went right through like a knife. And this market seems a little heavy at this time. So with all that being said, thanks for joining me here today for the September 14th, 2021 Strategy of the Day update. Remember, you can always find me over here at Zaner at 312-277-0110. Would love to have a more in-depth conversation about how we can put some of these ideas together for you in a trade plan. Find me on Twitter or DanSOT here on Facebook, or shoot me an email at dhussey@zaner.com. Leave your likes and your comments in the sections below, and feel free to sign up for our Zaner Daily newsletter, where you can get our entire team's commentary of current market price action. Sign up in those links below, or join me every Thursday at 2 p.m. Central for the Strategy of the Week webinar, where I go over more in-depth trading ideas, including option strategies that you, the producer, the trader, or the hedger, can put together and put to work for yourself. Have a great day, everybody, and I'll be back with you as price action develops.